Hello and welcome to our fixed term income plan webinar, commonly known as fixed term annuity. My name is Nick Flynn, Retirement Sales Director at Canada Life, and I'm joined this morning by Efty Mateides, our Annuities Proposition Manager. Morning, Efty.
Morning, Nick.
Efty, can you give us a brief product overview of the fixed term annuity and how it works?
Yeah, sure. Fixed term income plan was a product that we launched back in 2015 as our response to pension freedoms. And it's designed to provide the flexibility and certainty for customers that are looking to invest some of their pension savings towards their retirement. By flexibility, I mean it's got the ability to allow the customer to choose how long they invest for, what sort of income they want to take out of it, or if they don't want an income, had to have the income as a capital lump sum at the end of the term. By certainty, I mean it works in the same way as an annuity in that you know on day one what your outcome is going to be. So if you're just choosing an income, you know what that's going to be. If you want to know what your guaranteed maturity value is at the end of the term, you're going to know that as well on day one.
Okay, excellent. And what's the target market for the product?
Typically, it's available to anyone who's aged 55 or over that's looking to actually buy some form of retirement solution with their pension savings. Minimum premium is £10,000, but broadly speaking, it covers the majority of people in the UK that have got pension savings. And I think the key point to highlight is we have different types of solution within FTIP that cater for different types of that target market. So if I give an example of individuals that are the younger age group, 55 to say 65, we tend to find a lot of those people are still not ready to fully retire, so they tend to have a phased approach to retirement, which means they may just want to have access to their tax-free cash and just leave the money invested. FTIP allows them to do that, and they can just take the tax-free cash element and leave the rest of the fund invested and get the guaranteed maturity value at the end of the term that they choose. Or we've got other customers that actually look at getting the FTIP to bridge the gap in terms of where they do retire sooner before the state pension kicks in, for example. They get the benefit of having the FTIP provide them with the income that they need for that specific period of time until their pension kicks in at state pension age.
Okay. With that sort of flexibility, what's the market size?
Last year, it was significantly larger than previous years, but we've been seeing it growing regularly over the last few years. Last year, we estimate it was around 1.2 billion, and we expect this year it's going to be closer to 1.5 billion, and the trajectory is still going up.
Okay. And is there many providers in the market?
At the moment, there's 3 providers, including ourselves, but I'm expecting that there'll be 1 or 2 more joining the market at some point in the next few months, very much based on the fact that the market is just growing as more interest is seen from advisors.
Brilliant. And if advisors are keen to learn more and get a quotation, it's obviously a logical place to start for their clients. How do they best do that?
Typically, they can come directly to us. We've got a team that can usually turn around quotes within 24 hours. But the fastest way to get a quote is to just go to the traditional portals. Similar to how annuities are generated instantly, the same applies to the FTIP. They can normally get a quote within seconds.
Okay, that's brilliant. And health, does that play a fundamental part of this?
No, it doesn't. Unlike an annuity, it's not an underwritten product. So the way the FTIP works is very much focused around the premium that's being paid, the term that the customer is choosing, and also the type of features they want from the product. So if they choose just all capital with a guaranteed maturity value at the end of the term, that will give them a certain rate, whereas if they're choosing an income, that will give them a slightly different rate. But broadly speaking, the focus is very much around the investment term and the investment amount.
Okay. So if health doesn't play a part in getting a quotation and the rates, what happens if you die within the product mid-term?
The product has got 100% value protection built into it. So effectively what that means is if the customer were to die mid-term, what we'll pay is the original premium less any payments that we've already made.
Okay. So quite simple.
Really simple, yeah.
Brilliant. Okay. And could you give us an example of how it would actually work and the sort of rates that someone could expect? Obviously, this product lives and dies on its returns as such, whether it be income or capital.
Yeah.
So what sort of examples can we see?
Well, actually, I ran some examples yesterday because I knew you were going to ask that question. I've done two sets of examples, one for a term of 5 years and another for a term of 20 years. And to keep it simple, I just based it on a male age 65 with a £100,000 pot to invest. Typically, for the 5-year terms, we see most of those customers tending to go for the capital guarantee version of the product, where they just want most of the money to be invested, so they know they've got a guaranteed maturity value at the end of the term. But to give you an example, from looking at a 5-year term, typically a customer who's going to invest £100,000 is going to be looking to run that money down quickly, i.e. they don't want to pay tax all up front by just taking it all out in one go. They could be taking somewhere in the region of £21,000 a year out over the next 5 years. So in practice, what they're doing is, it's £21,500. They're effectively running down their pension pot in a tax efficient way, so that they can actually take the money out without having a big impact on their tax bill at the end of each year. But for those customers that just want a guaranteed maturity value at the end of the term, £100,000 would actually buy them around about £120,000 over 5 years. So they'll see a significant return, which is guaranteed on day one, over that 5-year term.
And if they went for the extreme of, say, 20 years?
20 years, they'll be seeing a significant increase. I think the numbers that we ran yesterday, £100,000 would equate to £230,000 after 20 years as a guaranteed maturity value. So it's significant.
So £100,000 will get you money back plus £130,000 over quite a significant period.
Yeah.
And what happens at the end of the policy?
There's a number of different choices the customer can make. The good thing about FTIP, unlike an annuity, it's written under drawdown rules, which means we can give the customer as much flexibility as they would have if they just bought an ordinary drawdown product. So effectively, when we come to the maturity date, around 7 weeks or so beforehand, we would write to the customer offering them 4 different options. One of them is to just take the guaranteed maturity value, if there is anything left, as a lump sum, and it's taxable, so they have to bear that in mind. Alternatively, they can buy another FTIP, again, if they've got the minimum premium available. The alternative to that is buy an annuity, and that doesn't have to be with us, it could be with any other provider, but it's always a good option. Or just go out and buy another drawdown contract. So it's really flexible in that respect, in that it gives people a lot of different choices.
And from your experience, what the typical client?
We've actually seen a lot of customers just reinvest. We see an awful lot of customers actually invest for a term of, say, 5 years, and then choose to go for another 5-year term. And the reason for that is a lot of customers use FTIP because they don't really want to make that lifetime decision too soon. They might be in relatively good health, they're enjoying life, they're being active in their retirement. They don't really want to settle down and say, right, I just want a guaranteed income for the rest of my life and buy an annuity. They may well also have it as part of a broader solution where they've got a drawdown as well as an FTIP solution that's giving them the guarantee element. So we see customers primarily use FTIP and then reinvest in FTIP again because they like the product and the way it works. But yeah, we also see customers that choose to just buy an annuity at the end of the term as well.
Okay, so it's great flexibility. There's obviously been gilt yields and interest rates have risen, and there's possibility that they have reached their peak, but we can't say that. But what is that knock-on that we've seen with annuities? Is that knocked onto FTIP as well?
Yeah, it has. We tried to price FTIP in the same way that we would do an annuity. So where we look at investments that are going to support our returns to pay the incomes that we do for FTIP, they work in exactly the same way as an annuity. So where gilt yields have increased, that's had a knock-on effect on FTIP rates as well. So we saw FTIP rates improve significantly at the back end of 2022 and throughout 2023, to the point where we actually saw significant increases in the activity volumes of FTIP sales coming through.
So with enhanced and additional rates, the investment opportunities it just looks so much better.
Yeah, it does.
Fine.
Yeah.
Okay, thank you. And in terms of remuneration for the advisor or the broker,
Yeah.
how does that work?
FTIP is sold either on an advised basis or via a non-advised route. So either commission can be paid or we can facilitate advisor charges as well. I would point out, although it is a drawdown contract, we've priced it and built it so it looks and feels a bit more like an annuity. So there's no ongoing advisor charges or trail commission as it used to be available with the product. But the good thing about FTIP is by the fact that it actually has a maturity date, it's an opportunity for the customer to sit down again with their advisor at maturity to discuss their options. So whilst we're not paying ongoing advisor charges, there's certainly an opportunity for the advisor to revisit that customer and discuss with them what their options are then. So it's certainly keeping the relationship going.
So the advisor can continue with that relationship.
Absolutely.
Yeah, absolutely. That makes sense. And in terms of the product, you've explained the income and the guarantee amount and the guaranteed amount. What's next? Is there more innovation planned?
Lots. We're actually looking at a number of different innovations throughout this year and next year. It's very much dependent on how quickly we can get those across the line. So I can't really talk about them yet because they've not been finalised. But yeah, rest assured, there's quite a lot still to come with FTIP. We've identified a number of areas where we can improve the product, and certainly a few other areas where we can actually open it up to a broader market as well.
Okay, brilliant. And are there some sort of technical bits that the advisors and firms need to be aware of to make sure they don't?
There is actually one that we often get sort of questions about from advisors, and that's what is the impact on, say, the annual allowance, the money purchase annual allowance. As a drawdown contract, it does fall under that money purchase annual allowance, which at the moment means if someone's still working and they want to continue making contributions to their pensions, the most they'd be able to take is the most they'd be able to contribute is £10,000. It only applies if you're actually drawing income from the FTIP. So if you've got a regular income FTIP, then you'll fall under the money purchase annual allowance. But if you actually just use FTIP to take tax-free cash, for example, but leave the rest invested for the capital guarantee at the end of the term, it stays at the annual allowance, which is £60,000. So in that respect, you can really use it to make the most tax-efficient decisions possible for the customer.
Okay, that's really important. Thank you, Etty. In terms of more information or details or quotations, Bob, feel free to contact myself or FD, and we'll get one of our key account managers to make contact with you and your team and talk through how it could work for your clients. Maybe attend a team meeting, whatever suits you, face-to-face or over Teams. But we hope you enjoyed that brief session. If you've got any questions, please don't hesitate to contact us. Thank you.